All right, good afternoon, everybody. It's Sunday, 11 a.m., May 10th. I have Faisal, our equities analyst, with me. My name is Amol. Faisal and I run the Alpha Trades community together, located here on Discord. If you are not familiar with it, there's a link below in our YouTube video. Come join either the free side or the paid side, which is currently on our old domain, which is the cryptosomniac.com domain. Hit the products page, buy the Advantage subscription, and you will get videos like this from myself or Faisal, or updates like this every single day. You can see right here, Faisal gives out daily market updates, whether it's closing of market, opening of market. And then in the crypto side, we have a ton of analysis right here, all the lock channels that you see, Bitcoin analysis. As you can see right here, every single morning we make videos, provide updates through the day. And Faisal also provides oil updates every single day. He talks about companies that he's looking at in the oil sector. And I myself talk about the Forex trades that I'm in every single day. All right. So with that being said, today's analysis is going to be predominantly focused on the equity markets. We're going to cover bonds a little bit. We're also going to go out into the world and look at how the outlook of the world is doing regarding coronavirus and the respective economies. And then we'll also bring it back to the US and how that's going to translate into the American economy. And then finally, we'll also tie that together with crypto. So with that being said, Faisal, welcome.
Great to be here. Thank you for having me.
No problem. So Faisal, what are we looking at from the previous week, and what are you thinking about the week ahead?
Oh, well, I first of all, it was a really good week. I think last video we kind of called it that the probability of this week based on the technical setup of the leaders and the other sectors was the market was either going to consolidate or move up. And I think that same pattern is still intact. I think this week coming up, you're going to see the market move up or consolidate as financials and industrials and maybe even healthcare start to move up, and you start to see sectors like tech take a little bit of a break. I think we saw some tech leaders on Friday, Netflix and a couple others start to lag a little bit, whereas the really high growth players still doing the best. But a lot of the financials and the energy and the value sectors really outperform. So I expect that trend to continue. You're going to see a rotation into the more value-oriented sectors, which are industrials, housing, and financials. And you may see, I don't know, it's kind of unclear to me right now. You may see profit taking out of the tech winners, but we're still in a stock pickers market, so it seems like winners keep winning and losers will keep losing. If you have a dominant advantage in this corona environment, you're going to keep seeing buyers. So I wouldn't bet on against them too much. But yeah, that's kind of how I'm looking to play the week is more so focused on value sectors versus the tech winners that have been really inflated over the past 3 weeks, 4 weeks, or actually two
Got it.
weeks. Yeah.
So going back to the coronavirus counts, we're now at about 4.1 million cases worldwide, 281,000 deaths, and the American death count is closer to 80,000. We lead the death count as well as the infection count. Now, what we're seeing in other parts of the world is a slow reopening of the economies, but also we're seeing somewhat of a neutral or maybe a backpedaling in case counts as well as deaths, right? So Germany specifically, we saw the German economy open up a little bit the past week or two, but then their case count started to increase and their death count actually rose up a little bit as well. What are you seeing in these economies around the world that are starting to open back up, and how do you think that will translate into America?
Well, first off, I didn't know the numbers in Germany until you just showed them now. That's crazy. That's really scary considering I'm living in a city where we are really trying to ease up lockdown measures. I think probably within a week, everything will be not totally reopened, but as of now, I'm already seeing people like in the outskirts cities of Houston, like Sugarland and Stafford. Um, I'm already seeing a lot of people go out. I went to the grocery store and there were a ton of people without masks. So Yeah, I don't know. These numbers really scare me looking at what Germany's seeing, and I think that could be somewhat a scenario that happens over here down south and in Georgia as well. Um, this just increases the odds for a second wave, in my opinion, and the long-term risk gets elevated the more so the more we become more complacent about this virus issue. Because let's be honest, we're not even done mass testing, and we are really just trying to move on with our lives. Like I really thought this entire scenario would play out like we get sick, we find out who's tested, we develop treatments, and then eventually vaccine, and through the midst of that, we end up learning how to operate in a virus kind of setting. Whether we all wear masks when we go out or we don't take public transportation as much. So it's just when I see things like this, it's not surprising, and it's like, what did you expect? Like when you have more people in a virus that doesn't even show you symptoms, when you have more people gathered around together, you say, "Hey, everything's okay." I mean, do you really not expect the cases to escalate? So I think that's
Yeah,
probably going to happen here.
that's a great point. And the virus itself does stay dormant in your system for anywhere between 9 to 14 days. And I think I mentioned to you that my pops himself, he had coronavirus and he didn't display any symptoms till about day 8. And then he then obviously started to walk around in public. I don't know who he got it from or who he gave it to, unfortunately, but he was not even able to get a test. And obviously, this was in early April. He was not able to get a test unless you actually get admitted into the hospital. Now, obviously, May has probably gotten a little bit better, but I think recently both my parents tried to get testing done, but even right now, the testing in Indiana is not that well set. So Indiana, let's just say, as a baseline for most of America, could make the argument that we are clearly not prepared, whether it's testing or when it comes to the economy reopening back safely. And obviously, Germany and South Korea, which are taking significant measures already to ensure the safety and security of people, are yet still seeing a rise in cases and infections. Uh, that translating back to America, how do you see the stock market itself having such a disconnect with what's going on in other economies in the world, but yet we're so, I guess, bullish in a sense that the market keeps going up? How do you rationalize that?
Well, I mean, this is not a rational take, but this is just something that I've been saying for as the market's been going up. My reasoning is that this virus has a timeline. I think the developments on the medical side are really going to come through within at least a year on the treatment side. The vaccine may take a little bit longer, but once we get people treated and everything, then you got to start thinking about this thing like how we treat the flu, the seasonal flu, because we have treatments for that. If someone gets sick with the flu, we can go in and properly assess them and treat them. And I think that'll be the same with this disease at some point. And when that happens, that'll bring down the fear level to a certain extent. I don't think everyone will go back to normal until a full-on vaccine is there, but that's kind of what I'm thinking as far as why our stock's going up now is, okay, people, when we had the 30% drop, we were expecting the worst of the worst and for our entire financial system to collapse. Well, it doesn't look like that's happening now. It just, as of right now, we don't know the long-term effects of what we're doing as far as the stimulus and the debt we're adding on. But as of now, it looks like everything is fine when a month ago we thought everything was just on the verge of collapsing. So that's my rationale. I still don't think we have enough juice to break above the highs on the S&P, but I think my new target now is probably around 3,100, 3,050. Before it was 3,000 to 2,900. I think as we see the financial sectors and industrial sectors go up, that's going to be the main driver to that 3,100 level. So continue to ignore all the bad the bad noise, because we're going to get some more employment data out this week, and it's going to be bad again. Um, so, like at this point, it's anyone's guess as to which number will set off the sell
Yeah,
off alarms.
I think one thing our viewers are seeing a disconnect in is the fact that I understand that we've had a pretty significant steep drop in March. And I of course understand the rebound because whether it's oversold conditions, maybe there's a lot of people who actually sold. But in fact, the way I look at this market is, of course, it's irrational, but I think about it like this. If we can look at the economy from the 2008, 2009 financial crisis, I would say the economy right now is in significantly worse conditions. Would you agree?
Um, I think so, but the dynamics of how the globe operates are totally different. And I don't think it's just based on economics. I think it's also based on technological dominance, military dominance. I think it's a multitude of factors. So I think the economy, like the reason why we're able to pump all this money and no one bat an eye is because we continue to lead in those other categories. So to answer your question, yeah, I think the economy, because we have more debt, there are a lot more businesses on the brink of default in the next month. I would definitely say the economy is way worse than 08, 09. But I'll be honest, I wasn't that old to understand everything back then, but that's just my opinion from that standpoint.
So what I guess one way I look at this market is, number one, I mean, we of course understand that the implosion of how the market itself fell apart is very telling of the fragility of the market in general, right?
Sure.
I'm of the opinion that I don't think fundamentals or earnings have mattered for the last maybe 5 or 6 years, because if they did matter, I don't think you would see valuations at such significant highs. I think whether it's interest rate cuts, whether it's central bank cash infusions or repo injections, or the Fed effectively putting a backstop onto bonds, is like the market basically saying that no matter what, we know that the Fed is going to have the back of the market. I think this is why you're seeing such a big V-shaped style recovery back in the market, because I think the market itself is factoring in that, well, at whatever point, whatever happens, we're just going to get tons of money, trillions of dollars getting pumped into the market. And I think this is the reality that most people are maybe frustrated at is, when you see 33 million people unemployed, it took us 11 years to add 22.4 million jobs since 2009. All that has been wiped away in the last 2 months. Okay. Now let's just say best case scenario, we add on half those jobs in the next 2, 3, maybe even 4 quarters. You still have about 50% of those 33 million jobs still out of the labor workforce. That was basically the unemployment rate that we had in 2008, 2009. But in 2008, 2009, the financial crisis was a drop of about 50% from the top to the bottom. So you could see, obviously, the frustration in terms of the disconnect of how is it even possible that the market is at the height that it is right now. I agree that we might be in a better situation right now in terms of the overall economy. But if you're going to make the argument that the economy was significantly better and we had the best economy, as Trump says, before the coronavirus hit, well, how can the best economy implode in less than 3 weeks or 4 or 5 weeks with 33 million jobs and everything shutting down? How is it possible that we had no way of having a rainy day fund, so many bankruptcies occurring? It just, I think this is where the disconnect happens with people trying to grasp that if I was the average person, let's just say an anecdote of a company, and I lost my job, and within 3 weeks, right, my life itself requires a bankruptcy, intervention from the government. How is it possible that people themselves are suffering so much, yet the stock market is going up? Why is there so much money going into the companies, yet the people are now standing in, mile-long bread lines or, waiting for their unemployment checks? This is, I think, where the frustration comes from. And, I don't quite understand the dynamics of how there's such a disconnect in the real economy of the stock market. But the one thing I can at least for sure say is that it just doesn't make sense that the market valuations should be anywhere near where they are right now. Whether you're talking about a 2-quarter recovery or a 4-quarter recovery, it doesn't make sense. Maybe you could make some sense out of that.
Yeah, no, I think you hit on it perfectly, and let's go back to what's different between now and I think the '08 crisis, and why you saw that drop 50% versus this drop of 30% and quite a substantial recovery. And it's exactly what you said. The Fed intervened not only to an extent that was unprecedented, but they intervened extremely fast. Last time I think they let Bear Stearns fail before the entire thing just pulled down even more so. And so this time they didn't. They really just came in and said, "We learned our lesson. We are not going to wait any time. We are just going to pump money into the system. We are going to create liquidity in the bond market. We are going to do anything that is necessary to survive this." And the thing is, like I said, every country is doing this at a certain rate. Obviously, not to the extent that we're doing it, but every country is doing this. This is becoming kind of the new norm, I guess, and everyone's economy will be different once this crisis has been dealt with. So I think that alone helps rebalance everything. It rebalances the risk, but I still think, like, you're right. Valuations at these levels, if you're looking at current valuations, yeah, it's ridiculous because companies can't even give full year guidance. So you can't even do valuations. You can't even do proper current PE relative or anything like that. So I still think there is a risk for a pullback because you're right, things have gone up a little bit too much too fast, and there's still a lot of uncertainty out there. But I wouldn't fight this market any which way because it's been going against reality for the past 2-3 weeks, and I think you have to you know stay cautious, still have longs, but have some shorts just in case the market can drop because it could just be one note about a second wave and a hint of lockdowns coming again that this market tanks another 20% in a week or 2 weeks.
Yeah.
So yeah, that's just my take on that.
Yeah, that's a fair point. I think, at present moment, a lot of people, because, you and I are fortunate enough to be able to trade this market and work from home and be in the safety and security of our homes. But this is really not the case for 33 million Americans who have lost their job and countless number of people around the world. And when we see something like the stock market going up, this I feel like this is the very epitome of the income inequality divide that's really at full force now. And
Yes.
and
Yeah.
and you see this, and this is where I think at some point reality will meet the stock market and the government and politics itself, where people will start to realize, you know, well, all we talk about is the stock market going up and the rich are really getting richer. Because at the end of the day, I mean, you and I will make money whether the market goes up or down, but that's not really the reality for a lot of other people
Hmm.
who effectively have their jobs, tied directly to the stock market, in a sense, because they have companies within the stock market that are failing, yet the market itself keeps going up, but it doesn't really help them in any way, right?
Yeah.
And so I think the point right now is I think neither the Fed nor the government seem like they're making decisions on the longer time horizon. I think they're looking at this as this is a short term fix. We'll overshoot the cannon and try to put as much cash injection and liquidity into the markets, and we'll hopefully come out of this, in the next 2 or 3 quarters as, hey, what the heck are you talking about when it comes to coronavirus? And I think the real proof of what's happening with the economy as well as the underlying issues in America is when you start looking and talking to people in the small business space, the SME space, when you're talking about, Uber itself cutting about 30% of their labor workforce, bread lines that you see, food banks that you see that are mile long, these things would not really be the issue if the overall health of the economy were to be factored into the stock market. And I think the disconnect is that the stock market is overshooting itself because of the Fed's intervention. It's not that the market itself is factoring in that we're going to get better soon. It's that we don't care if we don't get better soon. We're going to push this market up because a lot of the weak hands are already out of the market. I think I showed you that there's about $40 billion of equity index futures that are net short currently. So either these people are going to be tremendously right, or they're going to fall flat on their face and get short squeezed out of the market because these people are probably thinking that there is no way that the market could keep pushing up given the current market conditions. But obviously, as you and I know, the markets can be irrational longer than you can remain solvent. So fact of the matter is, I think this is where the real frustration is coming from for most people, is that how is it possible that the valuations are so ridiculously high? There's such a disconnect between the stock market and the real economy. And yet everyone wants to just say that everything will be okay. And we're not even factoring in what could happen with the second wave, what is happening with Germany, South Korea. And I think you mentioned something was happening in Russia as well, correct?
Yeah, I think they passed France and Germany for cases or something like that.
Yeah, I'm just actually looking at this data. I didn't even pay attention to Germany, but you're right. Fifth most infected country in terms of infections, surpassing Germany and France. Yeah,
Yeah,
this yeah,
I think that's crazy because they were one of the early countries that was saying we weren't seeing any coronavirus, and then there was talk that, oh, does the virus not do that well in colder weather? I think that was the first connection that was made to their low case count, but obviously that's not the case.
yeah. It definitely doesn't seem like it. I think maybe this is also another factor that a lot of people haven't quite maybe factored into the markets, is that the second wave itself, especially when we look at the Spanish flu, was even more deadlier than the first one because we underestimated, our ability to overcome it on the first wave, and we kind of just let it slide. Basically, what we're doing right now. I think you mentioned that Houston is a little bit more lax. My family lives in Indiana, and they said that they've been going out for the last day or two. They said they saw capacity of malls and restaurants and people out up to about 80%. And half those people, or I guess 25% of those people who were actually out, didn't really have a mask or weren't really wearing gloves. So you could actually see this disaster that's sort of projected out into the future. And do you think that maybe the market itself is sort of overshooting this potential disaster looming, or do you really think that things are just going to get better and we're going to find a vaccine and just come out of this like nothing really happened?
Well, I think you hit it spot on. I think exactly the market's showing you exactly what type of market it is. It is an overshooting market, just like it overshot how bad things were going to get. It's going to overshoot just how good things can get in the short term. But I do think there's a lot more sustainability on the short term because a lot of people want to talk about the deadline to the vaccine. I still think treatments and different types of devices that are going to help with the individual problems like respiratory failure associated with the virus. I think those developments and solutions, when they come out, they are really going to help give people the confidence that even if we do get sick, we will get treated. And like I said before, I think at some point it could be treated like, the flu, where we have the flu season. People aren't scared to go out at that time because there's treatments and there's things to get better. So I think we could end up going to that sooner than later. But, I think the market, it's more likely that the market is overshooting on a short-term basis. Uh, the optimism on the medical side and the economic side.
Fair point. Let's move over to the bond markets, because it seemed like recently the bond market started to sniff out maybe the interest rates potentially going to negative. And I think for the most part, Jerome Powell and maybe the Fed or the government itself doesn't want to go to negative interest rates, but I know Trump has sort of pushed towards that, and maybe his dream might be coming true soon, because the way the bond markets are sort of reacting, whether it's the treasuries, whether it's HYG, it seems like they're really factoring in that there's no other way to get out of our current funk than to head into negative interest rates. Any thoughts on that?
Oh, I don't. I have no idea. I think that negative interest rates would be. I don't know if they'd be bad as some people think, but I don't know if they'd really fix anything as much as people think. I think Trump only wants them because he's running up the debt and he doesn't want to pay a higher interest on that or be blamed for that or something like that. But no, bonds have been acting so weird, and I think the Fed has not stepped in and bought anything yet. So as you see with these LQD, I was mentioning them that I thought that these were some of the safest assets, considering the Fed said that we were going to come in and buy them if necessary. And it looks like as the Fed hasn't stepped in, you're seeing these. This is LQD, which is an ETF that mirrors investment grade corporate bonds, which are pretty good company bonds. They're relatively safe.
Yeah.
You're seeing them get sold off, which is, I don't know how to read that, because it could just mean, okay, bond traders don't expect the Fed to step in. But what exactly does that mean? Does that mean that things in the economy are actually better than expected, or does that really mean that people are just getting tired and but at some point the Fed will come in and step in? This is just their mistake. I really don't know how to read it at this point. It's kind of like a wait and see situation for me.
I actually read about the investment grade bonds, so the AAA rated bonds. There are actually a significant amount of downgrades that are coming into this summer.
Mm,
Obviously, I think some of the companies were already on that path to having their bond downgrades come, but I think coronavirus definitely just accelerated that. Um, I would probably say that unless the Fed comes in and steps up, I really don't know how the heck the bond markets are going to look at this as a good purchasing opportunity, because if you're looking at companies from the standpoint of 2 quarters, 4 quarters out, I don't know how some of these bonds could be valued at where they are. I think
I
we
totally
talked
agree.
last week. Netflix and Gap, Hertz already had their downgrade into junk bond. Ford is actually on the brink of being downgraded to the junk bond status. Major, auto industries are being downgraded. I think Macy's is also selling some of their junk, or not junk bonds, but they're selling some bonds. So
Real estate
there's a
bonds or something.
real estate bonds. Yeah, there's a lot coming out, and this is where I get a little bit concerned that we might be so focused at what's happening in the equity markets, but it's really the bond markets that we should be looking at, because these are the markets that really give you the signal of what the economy's going to go through over the next several quarters. And to me, it just doesn't seem like the bond markets are showing any signs of strength like the equity markets are.
Yeah. No, it's definitely something to see. I didn't think that we would see it sell off as much as it did, but you're exactly right. If the Fed doesn't step in, but I think they will if you end up seeing a lot of these downgrades happen. But what happens to these ETF prices as those downgrades happen remains a question. Because even as the downgrades happen, I could see LQD and HYG actually go up, because that increases the chance that the Fed will step in and provide that insane risk off factor. I mean, the Fed coming in and saying that they're going to protect the losses is insane in a market that has so much uncertainty. So I don't know. It, I don't know. I'm really looking forward to seeing what happens this week and whether or not they sell off even more, because you're exactly right. The bankruptcies and the lowering of credit is coming. I think United, which I'm fairly positive on. I think there's a risk that, a very light risk, but there's a risk that these airlines could be nationalized if they continuously go bankrupt, because if they do not see demand. Recent airline stats are showing that there is some short-term demand, but if there is a continuation of this virus, who knows what happens. There was not that much demand for their junk bonds, and I was
Yeah.
quite surprised by that, considering that the issue is kind of being pegged as a year to 2 year issue. And I mean, United was a really good company in my opinion beforehand, and even though they have a lot of international travel, which I think is really being strained right now, I would have thought that people would have piled into the junk bonds like people piled into Boeing's bonds. I think both of them kind of have the same risk, and are sort of tied to each other. So I was surprised by that. But you're right. There's definitely more pain coming as far as credit declines and everything like that.
Yeah, my dad actually works in the defense sector of Rolls-Royce, so they actually have a lot of defense contracts. So he actually told me exactly, why Boeing itself is not seen as, maybe a company that should be let go of, or could essentially go into insolvency or bankruptcy, because Boeing itself has a lot of defense contracts from the government. So the government kind of needs companies like Boeing to stay alive for, their own contracts, like Northrop Grumman, Boeing, Rolls-Royce are some of the big defense contractors for the government. So I think
Yeah, and
Boeing
not
itself, I
even
think
that.
is,
It's also the suppliers too. Like you look at SPR, Hixel, like a lot of these guys
yeah,
who really rely on Boeing for the majority of their business. Kind of like how Skyworks used to be so reliant on Apple for their chips. You've seen this dive so hard along with Boeing, and these are billion-dollar companies too. So you're having a lot of webs connected to the Boeing space, which I think it shows how valuable it is to the American economy.
yeah, yeah. Um, I wanted to tie this into Bitcoin real quick because, the one thing I've mentioned to our community members is that, Bitcoin is clearly a high risk asset, and for me, there's really no other way to look at it. But one thing that Bitcoin provides us in terms of the picture of how equities move is sometimes it can lead the market due to its high risk nature. And if we look at this February drop and sell off, and if we put on the S&P 500 right there, okay, you can see that they're actually pretty closely mirrored together. Let me check this out on the daily here. Okay, so let's move this together. Let me see here. Let's turn this off. Turn this on. And this is a pretty important point that I've been paying attention to for the last, several weeks is if you can look at the movement, right? I mean, it's almost toe to toe. Okay. As the Bitcoin market started to drop off right around mid-February, I think the S&P 500 was just topping off. The first drop came, Bitcoin led the market, equities came falling with it. And then after that, Bitcoin led the market on the way down, dropped about, 50, 60% in about a span of 3 or 4 days. And then equities also followed that in about a span of a good week. Not to the same degree, obviously, but in its own respective, drop. And then, again, same thing, Bitcoin started to lead the way up, right? Equities then followed. And now, this is where we are now. Bitcoin again dropped a good amount over the last 2 days. Dropped about, I think, 10% in the last day and a half or so.
Wow.
Okay. So this is where I'm thinking that if we get to identify this kind of correlation, I think it'd be very good, for our viewers, for, people who are looking at high risk markets, because if this is a risk off environment, then you definitely want to look at assets like Bitcoin to be the leaders when they start to dictate that there's weakness being shown in high risk assets, and that could follow into the equity markets, because behind, right after Bitcoin, I'd say, equities are seen as the more risk assets, and then bonds are obviously seen as the far more secure assets. So this is where I'm thinking, that who knows, maybe Bitcoin is, giving us a signal that, hey, we're either coming to a top in equities, or I guess maybe this is a pullback before we have a big blow off top, You have stated that you're thinking equities could push up higher, correct?
Yes.
Okay.
Yeah, I
Okay.
think
Yeah.
I think that's an interesting thing, and I think you're exactly right. I want to tie it into the high risk category. So this pullback, I think that you're seeing in Bitcoin. I don't really watch Bitcoin that much, but just looking at what you were talking about, it seems like almost every drop that we have that's as significant as the one we just saw in the past 2 days, we usually see some traction in the equity markets following. I would say to that, while I really do think that the technicals and the equity markets should push everything to the upside, I think that could be an indicator that a lot of these stocks, I've talked about Chewy too much, Chewy, Peloton, but the really, really expensive stocks, even the Oktas and the Coops of the world, which are very good companies growing extremely fast, I think that could be a signal that these risky assets could be due for a slight pullback. And I don't think they're going to completely get wiped out or anything like that, even though I do think they're expensive. I just wouldn't be surprised to see a pullback happen in some nature because of what we're seeing in a high risk asset like Bitcoin. But I wouldn't expect to see a drawback in the value sectors, the sectors that have not gone up, like Bitcoin or other high growth, high risk assets. So that's something I would watch and pay attention to. But that's very interesting that comparison you put over Bitcoin and S&P.
Yeah, I thought it was quite unique because I've been watching both of these together quite a bit, and there's at least over the past several months, there's been a fair amount of correlation in terms of the turns of the market. I wouldn't quite say there's a day-to-day correlation as much, although I would say Bitcoin and the ES, the S&P 500 E-mini futures, they have been moving together quite a bit. So it was just a unique observation. Um, so last but not least, I wanted to tie this video together with explaining to the viewers what we're looking for the week ahead. And the one thing that I'm looking for the week ahead is I still have not sort of seen the argument why gold is not going to push higher. And so I'm still long on gold. I'm also long on the gold miners ETF, which is the GDX ticker. And then a couple other things that I'm short on is Lionsgate, so LGF.A. So this one right here, I'm still thinking that it might have more downside ahead. It just looks like it's just in a deep channel on the way down. And then IBEX 35, which is the Spanish index right here. This is another big short that I'm thinking that I think the Spanish economy is going to be in real trouble. And this is a multi-month, head and shoulders pattern that it just looks ready to start collapsing. In large part, I think I'm still leaning towards having a bearish bias on this market, but obviously, I'm not going to be foolish enough to short the market on its current momentum up. What are your thoughts and what are you thinking for the week or weeks ahead?
So while I already talked about, I think the market will go up and I think value will lead. I have a couple of long ideas that I am looking at. So within that space, I really liked financials. I think banks are about to see a really big week this week or in the next 2 weeks. If you look at JP Morgan and Citi are two of my top picks in that sector. And then energy is also, I think, gonna see some more momentum. I don't know what's going on in the futures. They just continue to go up despite the storage problem. It could be that the demand as economies reopen is really spurring that along with the supply cuts. But I have no idea. I'm not in those oil canisters. I can't tell you how much they're filling up or not. So, but either way, technically, I still expect stocks like I love Valero, EOG, and Fang. I think they're going to have great weeks this week or in the next 2 weeks. And then finally, let me go ahead and get to my long of the week and my short of the week. So last week I did CarMax for my long. I think it went up like 9%. It was a good
Yeah,
buy.
that
Yeah,
was a
but
fantastic call on your part. Yeah.
yeah, it went up 9%. I think it's going to continue to go up. I really missed out on that. I was just paying attention to other retail stocks like Walmart and Alibaba. I don't want to get too much into the retail space. So I just didn't end up adding that. But my long of the week this week is OLED, OLED. And I think this is a very risky pick, considering that they have a lot of ties to China and South Korea. They develop a lot of screens and smart screens, like for monitors, TVs, and everything. They're the leader in lighting and screen technology. So as our whole world kind of gets interlaid with these new smart screens, OLED is going to be at the forefront of that technology. And so it's been really beaten down here. They had a lot of factories shut down in China and South Korea as a result of the virus. But I've looked at the estimates, I've looked at the money. This company has zero debt, extremely high cash growth. I think picking it up here, I'm looking to hopefully get in it sometime very early this week. I think this is a great long-term buy, especially if you are bullish on the China recovery, like I am. I'm fairly bullish on that area. So I like OLED for my long, and my short of the week is Ralph Lauren RL. They have too much in brick and mortar, and I think as the stock continues to suffer quarter to quarter, I could eventually see it go down to somewhere between 50 and $60. It's still trading too high relative to its historical EPS range. The stock should be maybe 10-15% lower, and I think it's consolidating right now and should see a leg down come soon. Retail is a space where we're seeing the most selective winners. Like you have Amazon, Walmart really making new highs, and then you have guys like Ralph Lauren that are just sinking, and Macy's sinking ever below. So I think that trend will continue, and those are the two that I'm looking to watch this week.
Fair point. Last but not least, I wanted to ask you about the housing sector. We looked at this real estate ETF right here. This one, to me, it just seems like the real estate market, housing market, it just doesn't look good. You had some other thoughts, right?
Yeah. So Friday we actually got some word from Zillow's CEO. They did a conference call. It was earnings. So he talked about the housing demand and how 2 months ago they had a whole bunch of red lights on their housing demand. So Zillow operates as an online platform where you can buy and sell a house, directly online. So they had a lot of people halt their sales of buying. They said, we're not buying anymore. We're freezing it up. Just pause everything. Then a month later, they started to see people inch slowly back in, and you saw how home builders like Pulte report kind of good numbers, and there was a feel in the housing sector that, okay, maybe things are not as bad. Even though no one's looking for a house, prices aren't dropping dramatically, and the experts kind of expected the housing demand to bounce back. And now fast forward to yesterday when the conference call came out, the Zillow CEO said he's actually seeing a lot of green light movements. So surprisingly, flashing green lights, which means that there are still not the same demand of people before, but people are actually moving forward and buying houses lightly. I think they saw 500% increase in virtual demand tours. So that could also be fueling what they expect to be a pretty good quarter relative to what was expected beforehand, in mid-March when everything dropped.
Interesting. And so you think that home construction, real estate ETFs are probably going to pick up steam. So do you think that these two specific sectors like real estate and financials, you think they're just lagging behind, and you think they'll start picking up steam soon? Or do
Totally.
you really think? Okay, got it.
Yeah,
Okay.
totally. I think these sectors at this point, they're trading too low relative to how much positivity is being talked about in the stocks that are going up. It's like all the bad news is being discounted for the stocks that are going up, or has already been discounted, and yet the bad news, the same bad news, is actually holding down these sectors like the financials and housing sector and some parts of the industrial sector. So I definitely think housing fits in with the narrative that I've been saying for the past 2 weeks, that there will be a rotation into value. You are not going to see stocks like Netflix continue to power up 150, 200 points more straight up, maybe in a year or so, but the market just doesn't work like that. And I think the amount of risk that has been taken off the performers should end up translating to the amount of risk taken off in the underperformers, which are the housing sector and the financial sector.
See, that's interesting because I actually have the other viewpoint is, unlike the S&P 500, I think the housing sector and the financial sector is actually giving us a more reality-based signal in that, if you're looking at JP Morgan Chase right here, still collapsed down, where is it, from its highs, or I guess these highs, right? Let's just say before coronavirus, right? Still down about 33, 34%. If we're looking at American Express, same thing, right? Down significantly from the highs, right around about 34, 35%. VNQ, we talked about the real estate ETF, down a good amount too. To me, when I look at these are the more, reality-based expectations of maybe the banking and the housing sector are actually starting to show us that, hey, this is the grim reality of the market. The S&P 500 or, the NASDAQ indices, these are, seem to be propelled up by a lot of the major tech stocks, because we talked last week about the S&P 500 having almost, I think 30 or 40% strength concentrated in just the top 5 stocks. And so you could see that if that strength is actually being pushed up by, some of these tech stocks or some of the majors in the S&P 500 as well as the NASDAQ, the reality of the, majority of the companies is not really the same as what's happening in the tech area.
Well, I don't see. I think I've heard a bunch of people, and I've read some things that where they say it's only kind of the top five stocks that are pushing the market higher. And while that may be true in terms of how much Apple can push the Dow to the upside, no, I think you're seeing a fair broad rally. Like you're seeing stocks like Okta, and as I mentioned, Coupa, Okta has made a new high, what, 6, 7, 8 times? That company is not even close to the size of Apple. OKC is
Oh,
OKTA. I mean,
oh, okay.
and then Coop just made an all-time high. You're seeing all these stocks that are just like, these are not the big dogs, and these are actually really relatively risky players that will end up, creating a fortune 2, 3 years from now, maybe 4 years from now. So it's not just the big stocks, in my opinion, which is why I think the market is a lot healthier than what some people realize. If it was just Amazon and Apple holding up this market, yeah, that would be some big warning signs. But that's not what I'm seeing on a day-to-day basis. Um, so I continuously think the market looks good, and I think eventually you'll see stocks like Okta pull back. Like if you can see that top doji, if it was one of the stocks that sold off Friday too.
Yeah.
So I think that drop that you saw in Bitcoin, I really think you're going to see it translate from these stocks like Okta. Even though I love the core technology, I think they're going to come down maybe 20% or so from this level. And you're going to see sectors like the financials and housing, because we've already gotten some numbers out of the housing guys, and they looked fairly good. And these are from a week ago, so things are already looking a little bit better week by week. And so I just continue. I really want to push that value. We'll see an excellent 2 weeks, and you may see stocks like these finally pull back. Maybe the Apples might not pull back. They may do better because they have more safety and sustainability. But definitely the high growth players that have gotten expensive, I expect them to pull back this week.
Okay, perfect. Well, on that note, Faisal, we'll leave it there. I think this was a very productive conversation, informative for our viewers. I stated a lot of long and short positions. I think you did as well. So people have a lot of free content that they got.
Yeah,
I hope.
I did want to mention one company.
Sure.
I really want to give you guys some good value to take home, and this is a company that I read their earnings report. They reported, I don't know, IPHI. I've done a stock of the day on it, imply. This is a $5 billion company. I truly, personally think, just in the areas that they're in, they are a huge data center player. They make a lot of GPUs for massive data center growth, and I think, based on what they said on the call, they are going to be one of the very unique winners. I think this is a maybe 25, $30 billion company. It's only 5 billion now. I think they're going to be hit that $30 billion range within 2 years. This is a company that I will say to you, keep your eye on this for the entire year. I expect them to have an amazing year. Because being in the data center business, that's one of the businesses that's consistently growing as you have more users staying at home and using the internet. Companies need more data centers in order to meet that demand. And Infi is just creating some of the best technology that conserves energy and just is far better than their competitors. That I think, even though the stock is trading at 110 bucks, I think it's like a $200, $300 stock at some point. So just keep an eye on this. This is my long-term idea. I really liked what they said on the quarter. I really love the fundamentals and everything. So Infi, just keep that on your long-term watch list.
Perfect. Well, yeah, thanks for that information, Faisal.
Yeah,
And
I
again,
just had to get
folks,
that out of there. I was really excited when I read the report. I was like, I gotta tell
Def.
someone.
Yeah, I love that you told us.
Yeah, yeah. I mean, it's gone up quite a much. Like since the low, it's doubled. From 55, and then they just reported Friday. It's done really well, but just keep an eye on this one. Even though it's gone up 100%, I am not surprised why. I think I'm actually surprised it hasn't gone up 150%. So just keep an eye on this one.
Perfect. Well, I appreciate all your insight, Faisal. To our viewers, please do your own research. Neither Faisal nor myself are financial advisors. Please do consult your financial advisor. We're simply here to talk about how we trade the market, how we try to do it consistently and profitably. And I do hope you guys enjoy our content. Please give our video a thumbs up, subscribe to our channel, and go to the Cryptosomniac website right here, hit the products page, and join our Advantage membership. If you want to see more information like this, more live equity updates from Faisal, and stocks of the day, top growth stocks, and a lot of these really had kick-ass weeks, this past week. So again, he's doing God's work here, Faisal. So
work. Oh, that's very nice. Thank you. Doing it for the gains.
Exactly. So thank you so much, Faisal. And until then, folks, give us a thumbs up, and we'll catch up with you guys next week.
Peace.